So I am a trusts and estates attorney here in the Twin Cities. We have a 32 attorney law firm in Eden Prairie. Trusts and estates basically is estate planning, state administration, charitable planning. One component that comes into estate planning is taxation. Change of residency has a potential opportunity related to taxation. So when you think about change of residency, really what you need to do is think about your fact pattern. Residency is based on your place of abode, and residency is also based on your intent to reside. So when people look at changing residency, the first thing they need to analyze is not only what's the plan today, but what's the plan down the road. The reason why people change residency is either fact-based. They want to be by their children. They want to be by their grandchildren. Some people change residency back to Minnesota because they believe there might be better health care here, or they might want to be closer to their family members. Others change residency to the south because they're sick of being here in February and January, and they want to go to Arizona or Florida or Texas. And some people do it for tax. Obviously, you want to end up in a state that has more preferred tax rates and a tax situation than Minnesota. Not all states are. Most are more advantageous. But it's very difficult to make a move for tax purposes unless it fits your fact pattern. There's a lot of people that believe they can just qualify or try to quasi-qualify. And that doesn't work, especially in the state of Minnesota. The reason for that is taxation, change of residency taxation, is the #1 most scrutinized area with the Department of Revenue. And we hear this over and over again, not from just our clients, but from revenue agents and from my peers. So the question is, what are you trying to change residency for? Are you trying to do it because it just fits the fact pattern, or are you trying to do it for tax reasons? And the real issue is, what's going to happen? Well, we'll get into the practical side of the planning moves, the opportunities, the status of the tax laws, and what happens on the back end. What happens when you stop filing or you file differently? Because when you file differently, there's a residency audit. It's not an audit of your tax return. It's an audit of your residency. And I'll talk about that toward the end of the presentation. So first, let's talk a little bit about the factors or the law. So there's a lot of misconceptions, and the #1 misconception is I need to be out of Minnesota 183 days, more than half of the year, and then I qualify to be a resident elsewhere. That's not true. Sure, the test for residency, one of the tests is being in Minnesota for 183 days and having what they call place of abode, a permanent residence or home. But when you change residency, you have the obligation to establish residency elsewhere before you no longer are a Minnesota resident. There's a famous case years ago where a couple retired, bought this beautiful motorhome, and planned to travel North America. They did that. They never stepped foot back in Minnesota that next year. Guess what? They were deemed Minnesota residents. Why? They didn't affirmatively establish residency in that new state. So what you need to do is you need to be, and if you're married, it's not just one spouse, it's both. You need to be in that new state 183 days. Well, what happens if I retire and I want to travel a little bit? Maybe I want to go to Europe for a month. Guess what? That's Minnesota time. Let's say that I'm reestablishing residency in Arizona. That 1 month isn't me being in Arizona 183 days. That's 1 month of me being in Europe. So that's really Minnesota time. I haven't spent more than half of the year in my new state. That's a big, big misconception. The other misconception is people assume if I qualify, I'm there more than maybe 190 days and my wife is there 150 days, that we qualify. No, we actually both, and it doesn't have to be at the same time, but we both have to be in that new state 183 days. So that's one part of the test, and that's what we call the physical presence test. And then there's what everybody knows is involved in this whole residency discussion, the subjective intent, the 26 factors. Basically unplugging here and plugging back in there. So the obvious, new driver's license, registering to vote, tabs on vehicles, club memberships, church affiliations, all of that stuff proves your intent to have residence elsewhere. Those items also prove, if you still have them here, that you have potentially the intent to reside here. What happens if if I'm very involved in my church and I don't have any church affiliations in my new state? Think they're going to ask about that? Absolutely. What happens if I have a very large home here, 8,000 square feet, and I have a 900 square feet home in Arizona? Think they'll ask about that? Absolutely, they ask about that. Now, sure, I might argue the home I've had here, I had when I raised 6 kids. We've had it forever, and it's not the time to sell, and we're downsizing. Now, that would be rationale to suggest otherwise. But they ask those questions. So the Revenue Department has these factors, and not one single factor is determinative, meaning if I did have that larger house here and a smaller house there, and I explain why, that doesn't mean I failed the test. That simply means it's a factor that they're gonna try to pick apart. So I have a handout that we'll distribute that gives a little summary of the physical presence test, which is the 183, and then the subjective intent. So if you look at page 2, when you receive it, you'll get a little bit more of a flavor of these items that they look at. And again, not one is determinative of residency or non-residency, but it's the totality of the circumstances. And what happens is Minnesota Revenue sends a residency questionnaire, and really this is the audit that they have. And they ask for 36 pages, a lot of these factors. So one page, we'll talk about family. Where are your kids? Where are your grandkids, if you have any? Now again, if I'm changing residency to Arizona or Florida and my children and grandchildren are here, maybe that suggests that I might be traveling back here. That doesn't mean I failed the residency test. But let's say that my children went away off to college on the East Coast, and they both stayed out on the East Coast, and I don't have any children or grandchildren back here. That might be something I really build up in that questionnaire. I don't have family here. Don't try to argue I have a nexus back here just because of my family. The alternative is maybe my family is here. That just brings back the physical presence test to be more important. Sure, I have a lot of family here, and I'm proud that I get to come back and see them, but I'm not here more than half the year. But that's the kind of thing that they'll dig into. Now, what if they want proof? What can they ask for? And what do they ask for? Well, guess what? They'll ask for your flight records. They'll ask for your phone records. They'll ask for your credit card receipts. So all of that largely goes back to that first test, the physical presence test in the 183 days. So if you're going to be close, or if you're going to fudge a little bit, don't assume that you're going to necessarily get away with it, because you're going to be called on it. It's very important that you try to qualify properly before you stop filing differently. So while I have that information in front of you, does anybody have any questions on that page 2 about those factors? I know it's somewhat extensive.
You're quoting this 183 days. Is that for Minnesota? Because I thought Arizona was quite a bit longer than that.
It's for Minnesota. So your issue is disconnecting here. It's not connecting there. Arizona, Florida, everybody will take you. The question is whether you qualify and how long qualify for homestead, for your real estate, that kind of thing. But those states will take you. The issue is Minnesota won't give you up. That's the issue. And if Florida's the same way. Florida's got, it's a timing thing. Depends on when you buy your home. Depends on when you can qualify for homestead tax status. If you haven't purchased it during the right part of the year, you have to wait until January 1st of the next year. Homestead is different than residency qualification. So these factors, again, not one or not two are going to either pass or fail the test. It's the totality of all items.
Is there like a committee or a judge in this?
So yeah, so if we get to the residency discussion or the residency audit discussion, what happens is obviously some tax preparers, some accountants will handle this differently. Some accountants will send a letter to Minnesota Revenue and say, my client is no longer a resident of the state of Minnesota. Here's why, or maybe it just says that. Others will not send any communications, and then you just don't file, or you're filing differently. Maybe you're filing a partial return. And either way, Minnesota catches on. And what happens is they say, okay, all right, we're going to send you this residency questionnaire. And you, the taxpayer, have the burden to prove that you've established residency elsewhere. So you complete this questionnaire, send it back. Then they have 30 days to respond and request more information. Then you have another round to respond. Then they issue their determination. That determination could be, okay, we accept it. That determination could be, we don't accept it, and here's an order for tax payment. Or that determination could be a settlement. They might say, yeah, it looks like you might be a resident, but we see some sourced income from Minnesota and you got to pay X amount, that kind of thing. Excuse me. So once you get that order, the question is, do you accept it or not? If you choose not to accept it, then you file an appeal to tax court. So the initial process is basically a process of reviewing, offering information, and then seeing what they say, and then ultimately it could go before the tax court. Now, here's what we tell clients to do. One, don't be surprised when you get this big questionnaire, because you're going to get it. You are. Now, there are some people that don't, but chances are you're going to get it. Be ready to complete it. Look at those factors. Be ready to use that as your checklist. Yes, I have registered to vote in my new state. Yes, I do have a driver's license in that new state. And this is kind of gets back into my camp. Yes, I have executed new estate planning documents in that new state. Why the heck would I want a Florida will if I wasn't a Florida resident? So you use that as your sword. You basically say, listen, look at all these steps I've taken. Of course, I didn't need my Minnesota will anymore. I'm not a Minnesota resident. I'm now a Florida resident, and here's my Florida will. So, go ahead.
You move to Florida, you do what you are saying, and then you move back to Minnesota. Does your Minnesota will and estate plan is it still valid?
No. So you move to Florida, you execute a Florida estate plan, that revokes the Minnesota estate plan. Whenever you execute a testamentary document, a will or a trust, it revokes the prior document. But there are certain, there are certain planning tools that are more flexible for change of residency, like a revocable living trust, for instance. Trusts can be amended to conform to the laws of the new state. So for instance, I did trusts like these, a revocable trust for my parents 15 years ago. They are now Arizona residents. The same trusts I did for them 15 years ago, they still have now. They're just amended to be subject to Arizona law. So yeah, if you moved back here, you'd have to obtain new or execute new planning documents. So, thank you. Go ahead.
So it sounds like you're expected to do these things, like change your estate. It's a lot of expense and work up front, and you still don't know if they're gonna approve you. So what happens if now I've changed my estate in the state of Arizona, they think I'm a resident, Minnesota says, no, we don't think so, you still have your condo here, and then, I mean, what do you do then at that point?
Well, here's my strategy. I would sit down with if you have a professional that's helping you with your tax returns, I would sit down with that person and I would look at your fact pattern today. And I would say, okay, can I qualify? First, can I spend more than half a year down there or wherever you're going? Next, how long is it going to take me to do this list of items? We have clients that we generally say it's going to take you 1.5 years or 2 years to prepare. And if you're spending more than half a year down there, what does it matter if you have an Arizona license versus a Minnesota license? You know, it's not going to matter. I mean, so if you don't qualify that year just because you had a family circumstance and you've had to be up here 2 more months, your Arizona license is going to be fine and it'll be there for you when, you know, you can use that up here, obviously. So there are some things you're going to do on that list that even though if you can't file differently that next year, you're still taking those steps where you're going to be able to do it the year after. But I think the better question that you have there is, where's the tipping point? Where is it worthwhile to start making the move? And I think that process is if if you look at the sum of all facts that suggests that you're a resident of a different state, that's the time. So you're there more than half of the year, and you can unplug and plug back in. It's reasonable for you to start doing those things in that new state. Then you're going to qualify. But the reason why I said you got to talk with your tax professional is maybe it's not just where I'm at and some of these administrative factors. Maybe it's more business related. What if you own a business here? Well, as we've learned the last couple of years, people can do business pretty much from anywhere. But can you prove that? And from a tax professional's perspective, where's the source of income? Is it here, or is it Arizona, or whatever state you're in? So there can be some income related issues where some people are forced to pay or file a partial return here and pay tax here. But then your investment revenue, your income, and everything else wouldn't be sourced here because you're a resident of a different state.
And you're meaning on an ongoing basis.
Right, yes.
So if the state of Minnesota looks at this and they release you, so to speak, do they continue to monitor that forever, for a while? Can they come back in 3 years and say, oh, actually, it looks like you were here May through October. You're even though we told you 3 years ago, yes, you're a resident of a different state, now it looks like you aren't.
Yeah.
Is that how that works?
Good question. Another part of that question too is, okay, yeah, I understand I have to spend more than half of the year in this new state, but do I have to do that forever? What if I do want to go travel for 2 months in Europe? Is that going to blow everything up? Well, the first 2 or 3 years, yes, they're going to be watching pretty closely. So you better make sure that you can spend more than half the year in that new state. But anything can pop up anytime. For example, I had a client many years ago, transition residency to Florida. He has a cabin, still has a cabin, up in the Brainerd Lakes area. And this was years ago, before they scanned your driver's license. He went to the local bait shop and applied for his fishing license. They mistakenly did it as a resident because they knew him. Well, guess what? Ultimately, that triggered an audit because the DNR somehow is connected in some way, and that information got back to him. So we spent 2 months clearing it up. It wasn't a 2-hour fix. It was a 2-month fix. And he was as far away from a Minnesota resident as you could get. I mean, the guy was here in July and August. That was about it. And had been retired, and there's no income here, no nothing. But that's something that popped up 15 years later because of an administrative error. So the rule of thumb is the first few years, yeah, you can't just say, all right, I'm no longer a Minnesota resident because I made it work 1 year and expect that that's going to fly. Part of that, page 2, those subjective factors, basically under the law, what that means is that's your intent to reside. You're proving that those factors suggest you're no longer here and you're somewhere else from a residency standpoint. So you can't really just turn that on and off because you're right, it does take a lot to do all of these things in the new state where you end up. But, we have to look at all the factors. I mean, look at some of those items. I mean, think about anything down to your Costco or Sam's Club membership. Do you have it here and not have it there? Well, if they don't have Costco and Sam's Club there, that's easy. But if they do, they might ask, why are you using your Costco card here and down there? What are you doing, shipping it down there? You know, they're gonna, why do you only need toilet paper here and not there? You know, those types of questions.
David, we have a couple questions from our online audience, one of which asked about clarification. So about the estate plan in one state and that you can only have one in a single state, just to make sure that they heard that, understood that correctly. And then that you can't have one with stipulations that apply in more than one state. So I know you spoke on that earlier, but just looking to clarify.
So estate plan is pretty broad, but you know, for instance, you can have a Minnesota healthcare directive and a Florida healthcare declaration at the same time. Those are state-specific medical directives. What you can't have is a Minnesota will and a Florida will at the same time. It's going to be whatever document was executed last that prevails, because a testamentary document, a document that provides for the disposition of your assets upon death, revokes prior dated documents. So you're not going to be able to have both wills and have them both be effective. But you can have other planning documents like powers of attorney or medical directives.
Okay, thank you. And the second question we received a little bit to the different residencies in different states. This one was asking specifically about like even President Trump or former President Trump going from Florida and then voting in a couple months later, like the act of actually voting. And if that's kind of proof of residency or how one might do that.
Well, the act of voting, well, first, obviously, you got to qualify to vote, but that's state specific. But let's assume someone qualified to vote in a state like Florida. Even though you vote there, doesn't mean that you are a Florida resident. It suggests that you are, but guess who's going to challenge that? Minnesota will say, that's fine that you voted there, but we think you're a Florida resident, or we think you're a Minnesota resident. So otherwise, they wouldn't meet any of those factors but the voting one, and they'd go down there and vote and argue that they're Florida residents just because Florida qualified them to vote. So even though, again, it's the new state oftentimes will accept you. Why not? You know, some of those states have tax. You know, it just so happens their tax is lower than ours. So they're going to accept you. It's just whether Minnesota will let you go. That's the issue, without getting that tax that they're used to getting. So think more about, how do I unplug here first before you start plugging back in there? So another important tricky item that's out there based on case law is some people find it very difficult to qualify or to make that 183 days. So they're really coming up against it. And a lot of times it's those people that, well, let's just use climate. Maybe it's Arizona. It's hard to be there more than half the year, you know, when it's 115, 120 degrees. And so a lot of people cut it pretty tight. And plus, they want to be back here during the great, beautiful spring and fall. Well, how do you measure 183 days? What happens if I fly out on a Monday? Is that Monday, Minnesota or Arizona? Guess what? If you spend 1 minute of time in Minnesota in that day, that's a Minnesota day. The only exception is if you're flying, let's just say from New York to MSP to Arizona, and you never get out of the airport at MSP here. That's the only exception. So your 1 minute in the airport between connecting flights is not considered Minnesota time. But if you leave that airport, even for an hour, that's Minnesota time. And that was based on a case. So partial time, even if you flew in here at 11:50 at night, that's a Minnesota day. So plan accordingly, obviously. Here's what some people are doing. They'll get out the old-fashioned calendar and they'll X the days. Other people are using apps. And there's several of them out there. You just have to use your web browser and search Track My Residency. And there's 4 or 5 different apps that commonly are used. And basically, you answer questions every day to prove that you're around, and then they track it. They prepare a report. And then that report can be offered with your residency questionnaire. It's pretty handy that way. Rather than all of a sudden waiting for this thing to come in the mail, sometimes a year after you stop filing, and trying to figure out what happened the prior year and where you were. So what I recommend that you do if you're thinking about changing residency, again, is sit down with, if you're having a professional help you with your tax return, sit down with that person and talk to that person about the process. Or your estate planning attorney or whoever might be able to give you some help in this area. And then first center around the 183 days. Sometimes that's easy. Sometimes people, like I mentioned the client down in Florida with the fishing license, it's easy. He's here 2 months a year. That's it. Other times it's not as easy. And when it's not as easy, you need your documentation and your proof, because they're going to want flight records. They're going to want credit card receipts. They're going to want phone receipts. In the past, I've heard stories of people leaving their credit card with their buddy at the country club and says, take the boys out for lunch a few times, but then they forget about their iPhone. Their iPhone can tell where you're at, or that might be fine, but what about are you going to drive from Florida to Minnesota just to save a few days? No, you're going to probably take a plane, and that's going to be tracked. So don't even try to be goofy with it. If you don't meet the test, it's not worth it, because they're going to figure out how to challenge you on it. Make sure you're hitting that 183 days, and then the rest is much more subjective. Try to make sure that there's nothing here that's material, that's making that connection. Again, I have a larger house here, all my family is here. Well, sometimes you can't change those, but you need to have some rationale. Why? Why you're trying to sell the house. Well, that's an excuse. But they might dig in further. Okay, when was it listed? And are most of your possessions still in it, or are they down in your new state? Those are the kind of questions they'll ask. So don't say you're trying to sell it if you're not really trying to sell it. But all of these are factors that weigh in to the equation of, do you qualify for residency change?
So let's say that you're in this other state for 250 days, but in that time, you maybe came back to Minnesota 3 different times, Thanksgiving, Christmas. You still have probably well over 200 days, but now does that kind of put a ding or a red flag on there?
No. Well, the first thing I'll clarify is 183 days doesn't have to be consecutive.
Right.
So, you can bounce back and forth as much as you want. It's just the number of days. Yes, when they ask about where your family is, a lot of times they'll ask about holidays. Well, it's fine to come back here for, Thanksgiving or for Easter or for whatever. Would it be more helpful if you had a different thing to, I mean, if there's 250 days, it doesn't matter. As long as you've met the majority of the other tests, I think you're going to be fine. But let's say it's 184 days and you're back here a lot, especially for those big ticket items like holidays. Well, it's fine to say, yes, I'm back here. I spend my holidays with my family. But maybe you twist that around a little bit and talk about when your family came to see you. So you say, yeah, I was back to see my family on Thanksgiving, but guess what? They came down to see me on Christmas, and I forgot about that one because it wasn't focusing on being in Minnesota. It was focusing on, where I was at. So it all depends on how you develop the argument. But to answer your question, no, it doesn't matter. If you're down there 250 days, you can be down here whatever days you feel is, or up here whatever days you feel is most important. That doesn't matter whether you're here on the holidays or not. Now, if you could flip that around and say, my kids aren't here. I had no reason to go back to Minnesota, and I spent every holiday down in Florida. Well, maybe that suggests, if you spent all the holidays down there, that you are a Florida resident. So it's all on how you spin the argument. But I think the key to your question is the 250 days.
Once they declare you a non-resident, do they put you on a watch list, or do they actively look for you, or would somebody have to turn you in, or you'd have to have some paperwork thing that would put them back on your trail?
Well, it's kind of like paying your mortgage off. No one sends you a bottle of champagne and says congratulations. I mean, they're generally not going to say, yes, we agree you're a non-resident and give you. They're just not going to bug you. So you're not going to really know. So you don't get any clearance that says, oh, wonderful, now you don't have to worry about it anymore. What you have to do is try not to deviate from your original plan that got you to where you are. So somehow you got the state off your back. And don't change it. Don't apply for a resident fishing license, or especially the first couple years. Don't spend the majority of the year back up here. So what I would say is, once you're off their radar, they've accepted that you're a resident of that new state. At that point, they're not going to care, right? And you're free to go wherever you want. I mean, it's your life. But until you've established and proved that you're no longer a resident here, you got to be careful. So does that mean for 10 years you can never deviate from the time you spend in your new state? No. I don't think it's going to take that long to get off their radar. And for some, it's very quick. For some, again, they spend 250 days. They have no sourced income here. It's clear. They might, they probably will accept that residency questionnaire and not even ask for any more information. It's that straightforward. For others, it's much more complicated. They own a business here, or they have partnership interests here, or whatever the factor is, and they're either filing a partial return and it's being scrutinized pretty closely, or they're much more on the radar, and it's going to take some time before they fall off the radar. Problem is, there's no bright line factor.
If you sell your home when you move and you own nothing in Minnesota, you get off the radar pretty easy?
Well, there's two factors there. The answer is yes. One factor is you've sold Minnesota real estate. So there's one tax that's important to people when they're planning their estates, and that's estate tax. So Minnesota is one of the few states that has a separate and distinct estate tax from the federal estate tax. Now, what's unique about this federal or this Minnesota state tax is, even if you're a Florida resident or a resident from any other state, but you own property here, that property can be subject, real estate, real property, that property can be subject to a state tax. So let's say that I'm a resident of Florida, but I own this building. And this building is valued at $3.5 million. Well, the Minnesota exemption is $3 million from a state tax. So $500,000 is going to be subject to tax, even though I'm a Florida resident. So the first factor is, if you've sold your property, you're escaping any risk of your Minnesota property being subject to a state tax, regardless of where you're a resident. But I think what you're angling at is, yes, if you no longer have a place of abode, as they define it, yeah, I mean, it's very, how are they going to argue you're a resident? Now, sure, if you're spending all your time here and you're renting a property, well, that would be a way for them to do that. But that's a wonderful example of how I would build out a real defined answer in that questionnaire about the real estate. And I would say, I've always owned my real estate, and I sold it in Minnesota. I no longer, or I don't rent anything in Minnesota. Check my records, and I purchased a place in wherever. So that's going to be very difficult for them to argue you're a Minnesota resident when you don't have any connection to real estate. Sure, they could argue, are you living with your daughter or another family member or something like that? But by selling property here, you're, one, avoiding potential tax, but two, making it much more easy to argue you're no longer a resident here.
So we have a question from one of our online audience. What if you reside out of state more than 183 days, but you earn income from a company that is a Minnesota company?
Yeah, that goes back to my point earlier about meeting with your tax professional, because the question is sourced income. Now, just because you earn income from a Minnesota company, that doesn't necessarily mean that's sourced here. If you own that Minnesota company, that suggests that it is sourced here. What will happen is, a lot of times you're going to end up filing a partial return. So anything that's deemed to be sourced here in Minnesota, you'll have to pay tax on, but everything else that you have, you will not pay tax on. So what would that be? Well, if you have investments or bank accounts and they earn interest, that wouldn't be attributed to here if you're a resident elsewhere. But your Minnesota sourced income would. So the question is the composition of that tax return and a determination of where that income is coming from.
Okay, thank you. And we have one other question. What is the rate that Minnesota charges for the estate tax?
The highest rate is 16%, and you get to that pretty quickly. So I'll give you an example. Let's say that there's a $4 million estate. We know that under the current law, $3 million is exempt. So $1 million is subject to tax. That $1 million is going to be subject to 16% estate tax, the highest tax rate. So $160,000 is due and payable within 9 months of the decedent's death. So that's Minnesota estate tax. Now, the next question people often have is, what's the status of the tax law? Meaning, will this $3 million exemption change? Well, apparently here in Minnesota, there's a $9 billion surplus. Hopefully that suggests it won't change, but who knows? The legislative session's just starting to wind up here. So last year, there was an attempt to drop it from 3 to 2.7. I don't even know why they tried. It wasn't a material dip. It went over like a lead balloon. So we have a $3 million exemption perpetually for now until they change it. I don't see them changing it this year. It's difficult when there's a surplus to change it. And because it's so drastically different from the federal exemption, which is a little over 12 million. So in that, if I can just show you this, in this 2-page item, if you look at inside the cover of page 2, and those are following electronically, I think that information might be available. Those are the exemptions. So if you look at Minnesota, 3 million, and if you look at the federal, 12,060,000 is the federal exemption. Now that's scheduled to drop back to the 2017 exemption of just over 5 million in 2026. Now those are big numbers. So we're able to pass on more state and federal than we've ever been able to pass on, state tax free. The reason why the federal is important is the federal exemption is portable for married couples. What that means is if I die and my estate's $1 million, we know that I currently have a little over $12 million exemption. So I've only used one of my 12 million. Upon my death, my wife can file an estate tax return, an informational return that elects my unused 11 million to be portable to her. So it's basically tacked on to whatever exemptions available to her in the year she dies. That's what effectively allows both of us to have a $12 million exemption. Minnesota does not have portability. So if I die and I haven't fully used my $3 million exemption, the excess doesn't go to her. On top of that, and this gets more into in-depth estate planning, but under Minnesota law, my wife and I don't each automatically get a $3 million exemption. I have to do trust planning to preserve my exemption. So let's say that I die, I shift everything over to my wife. Everything's in her column. There's no tax due upon my death. Then upon her death, they value the estate, and if it's over 3 million, tax is paid. What happened when I died is I didn't preserve my exemption. My exemption just evaporated. So the only way that I can preserve my exemption is I need a will or a trust that says upon my death, up to $3 million will be preserved in a trust for the benefit of my wife. And I'm going to capture my exemption so that when my wife dies, this $3 million I've preserved isn't part of her estate. It's called credit shelter planning. We've preserved the tax credit of the first spouse to die. So we're getting a little off residency here, but this is an important reason why people choose new states. Because states like Arizona, Florida, Texas, they don't have estate tax. So all of a sudden, just because you live here, we're looking at 16% of what you want to pass on to your kids. But it's important for estate planning purposes that you understand where you land on this estate tax perspective or spectrum. A lot of us, we're not subject to estate tax. Look at these big exemptions. But what if they change? What if these exemptions go down? We know the federal is going to go down significantly. We know the state, maybe not. So I guess the moral of that story is talk to your estate planning attorney about how estate taxes impact this scenario. But if we go back to residency, I want to kind of go back to a couple key misconceptions that we talked about earlier, because people really kind of trip on these. So the first one is you have to, when you count your 183 days, you have to count days in the new state. Again, the law says you have to affirmatively establish residency in a new state. You can't be a vagabond running around, nomadic and cruising around without establishing anything. You actually have to plant roots and be there 183 days. And if you're married, it has to be both of you. Not at the same time, but over a calendar year, you each have to be there 183 days. When counting those days, you can't count a day that you're here for 1 minute. Like we talked about, if you fly in at 12:50, that day is going to be a Minnesota day. So again, you can use apps, you can get the old calendar method out, whatever you want to do. It's important to track your days because you're going to be asked to prove it. And when you're asked, it's going to be down the road. If I'm filing my 2021 tax return here in a couple weeks, that's not going to be processed for a while. You know, it'll be processed this summer, this fall, whenever. What happens, you know, if they don't ask me until the next year, what happened to your return? Or why did you file differently? Well, I've got to go back the year prior and try to remember where the heck I was. It's not easy, especially if your days are tight. So make sure that you track it. Make sure that if you're tracking, and you're married, you're tracking both spouses. When we look at factor 2, the subjective intent, the 26 factors, again, don't be alarmed if you fail 1 or 2, if you can't make those work for some reason. It's not one single factor, it's the totality of all. And the key is that you're removing your connection here. So you don't have a greater connection here with those factors. So for instance, again, I use the goofy example of Costco or Sam's Club, which did come up in one of the cases, by the way. Fix that one by any membership you have here, make sure you have down there. And I'm not saying country club membership, I'm anything, Costco membership, whatever you have, try to establish it down there. Or have a reason why you have it here and don't have it down there. In a few items that the law has clarified, either Minnesota Revenue has acquiesced or they've lost out in tax court cases. One is charitable donations. Let's say that your favorite charitable organization is up here and you continue to give to it even though you're a resident of a different state. That's fine. They no longer can argue that you're more of a Minnesota resident because you only give to Minnesota charities. And the big one, the one that most of you might have heard about, if your professionals are up here, accountants, doctors, lawyers, financial advisors, that doesn't deem you any more of a Minnesota resident. They used to argue that and they lost out. One of the greatest arguments was, well, everybody from all over the world goes to Rochester for medical treatment. You know, how does that make them a Minnesota resident? But they cannot say just because your accountant and your wealth manager are here that you are a Minnesota resident. So don't worry about those. But keep in mind that, again, when we look at the totality of all those factors, the most important thing is to remove the nexus from here and establish it elsewhere. Once you do that and meet the 183 days, you're going to be successful. What other questions do we have?
Thanks. So it's clearly a lot of time, and if you factor in the changing your estate, financial investment to do this. In your professional opinion, when do the scales tip where doing all this outweighs just stay a Minnesota resident? You're not going to get the tax benefit. Oh well, I mean, because this is a lot of work. At what point or part of your maybe a financial bracket where you say this really is a good benefit if you're in a state where they are, you're not paying tons of income tax.
Right. Well, there are three tax factors that largely come into play. Income tax. So the question is, what are you paying annually here? And what would you pay elsewhere? That's going to weigh into that. How much are you going to save? Because that's going to offset a lot of the expense of plugging back in somewhere else. Estate tax, as we've talked about. So those later in life, or those with risk factors that might suggest death is sooner, might be more motivated to try to escape estate tax. Now, anything can happen to anybody at any time, but actuarially, it happens to others sooner. And then gift tax. Technically, there's no Minnesota gift tax with the exception of one important provision. If somebody is planning on making gifts to kids or grandkids, there's a 3-year look-back period in Minnesota. So if you're a Minnesota resident and you make taxable gifts and you die within 3 years, it's brought back into your estate for tax purposes. It's like you never did it. So again, if I have a taxable estate and I'm trying to plan and make gifts to my kids or grandkids, and I might be later in life, it's going to be more important to me to try to change residency sooner. So I'm going to probably go to the expense more easily than I would be otherwise. How clear cut is the argument? You had the 250 days earlier. That's as clear as it can get from factor one. And as long as you meet the majority of the rest of the factors, I think it's largely a slam dunk. So that's going to be easy to make that investment. With others, the question oftentimes is, okay, what's the long-term plan here? Maybe we just bought a house in Florida, and it sounds great, but maybe our kids don't have kids yet, and all of a sudden maybe they're going to have kids in Minnesota and we're going to want to be back. Or all of a sudden we're going to hate the bugs and the heat and the humidity and everything else and want to come back. So some people know that there's no way they're coming back. They're not coming back for family. They're not coming back for healthcare. They're not coming back for any other factor, and that's easy. Those that are a little bit more borderline will make that move if they need to, because of taxes or because of, they're just sick of being here. So I don't think there is a tipping point. I think you have to kind of look at cost benefit on each side. I know we're getting a little short on time, but maybe
I do have one online question,
Okay,
and
I
then
can
we are
talk
going
to you guys
into,
after.
1 o'clock on a wrap up. Just real quick online, somebody asked if Minnesota refuses to let you go, is it possible that the new state may also lay claims to you and you owe taxes in both states?
No, unless those taxes, if we're talking about income taxes, they're going to offset each other, so you're not going to be obligated to pay both. But there are other taxes like intangible taxes and other factors where you could be subject to tax in both states. So again, the moral of that story is try to get your plan together, be ready to fill out the questionnaire so Minnesota doesn't have the ability to latch onto you long term.
Thank you. And then probably a wrap up a little bit on questions too, when you can. Go ahead and ask. Thank you. Oh, I'm sorry, I didn't mean to. I was just getting your information.
You talked about this partial return. Let me give you an example. Let's say we live in Texas, full-time, we've done everything right, but we own a rental property here that produces a net income of, say, $20,000 a year. Is that what a partial return would be? We'd say, okay, Minnesota, we owe you, the 7% income tax on the $20,000 that you're in.
Right. And then, you'd have your expenses and everything else up here. The important thing with that would be your rental property, the value of that would still be subject to estate tax. And so if the value of the rental property was more than $3 million, There's no way to avoid that.
Now, if we're a Texas resident and we sell it, obviously we report the capital gain to the IRS. Do we pay the capital gain tax to Minnesota when we sold it?
If you ask Minnesota, they'll say yes. Yeah.
I can ask, just a scenario, we're in Florida 150 days, in Minnesota 100 days, and 115 days in Wisconsin. So we're out of state more than, we're out of state of more than 183 days. How does that work?
Well, the issue is going to be, and you're a Minnesota resident now?
No, Florida resident,
Florida resident?
yes.
Well, don't come back here. Yeah. Yeah, you're good.
I mean, we haven't been out of it. We became Florida residents in 2019.
Well, you're getting there. I would say you're close to being off their radar, but I didn't bring up Wisconsin, but Wisconsin, we have just as many clients that change residency to Wisconsin. They have cabins, and now the tax laws aren't as good in Wisconsin as they are in those other states we've been talking about, because they do have a form of estate tax. It's really kind of linked to the federal. But yeah, but you guys are fine if you don't have the presence here, and for the last couple of years they haven't asked you, have you met that 183-day threshold? So I'd keep your head in the sand and don't worry about it.
All right, I just want to say thank you, David, for coming in. What great information. And I think we're good on questions. I just wanted to say thank you.
Yeah. Thanks for having me.